Hey there, and welcome to my study. My name is Justin Spencer here. I want to share with you something today that for me was a complete revelation to my own personal wealth and ability to generate savings for myself and for my future and for my retirement. So there's a saying that goes, when the student is ready, the teacher will appear. And that was true for me, because this thing that I learned about wealth creation is common knowledge. Most people know it. But when it was shown to me and I was ready to hear it, it made the biggest difference in my life. So I'm wondering, I'm hoping, that maybe you are ready to be the student and to hear something that I think can really have a big effect on your ability to save money for your retirement. So before I get to what that is, there's a sidetrack that we need to go down. And it relates to a regulation that is in South Africa, specifically something called the Pensions Fund Act. Now, the Pensions Fund Act is there to govern pension funds and retirement annuities about how they can invest your money and my money in those pension fund structures. So I'm going to share with you something called Regulation 28 and how that impacts your ability to generate retirement savings for yourself. And it might surprise you how a regulation that is designed to protect you is actually the thing that is hurting you the most when it comes to saving for your retirement. So I'm going to show you some of those things, and I'm going to show you some calculations on a spreadsheet. I'm going to give you some information about the performance of the South African stock market, because of course if you're investing in a pension fund or retirement annuity, that money is largely invested in the South African market. So it's important to know how those investments perform. And I'm going to reveal to you how perhaps your investment in your pension fund or retirement annuity is performing at a level that is so poor, but you don't know about it. Now, it turns out that the financial services industry is structured in a way where we hand over control of our life's savings to someone else who often we don't know very well, but we are told that they are professionals in the space of wealth management and it's their job to do this, so therefore it's safe to hand over your money. And then the next time you find out whether you have saved enough money might be 30 or 40 or 50 years later when you arrive at retirement. Now, how do I know that? Well, I've spent the last 20 years of my life as a student of the subject of finance. And when I talk finance, I talk business finance, but also personal finance. And in my classrooms with executives and MBA students over many years, I always ask this question. And the question is about, where is your money invested? And how well is it performing? So I'm interested in that because when I talk about companies and their performance using financial metrics, ultimately I'm doing that because I'm trying to find businesses that are high-performing, value-creating businesses that I can invest in order to generate returns. Now, I know how these companies are performing. I know what returns they're creating. So therefore, I'm interested to know, where are you investing your money? How is your pension fund and retirement annuity performing? And are they providing you the returns that could be achieved in the market? Now, I know for a fact that pension funds and retirement annuities are not providing the returns that you can get if you were to take control of your own investing. So I'm going to talk to you a little bit today about how you can do that if that's something you want to do. Now, I'm not a financial service provider. I'm not someone who is qualified to give financial advice. So don't listen to anything I have to say. Don't go and invest your money the way I say you should invest it. All I want to do is I just want to plant some seeds so that you can think a little bit differently about how and where your money is invested, and maybe go and ask some questions of those people who are qualified, and just check that your money is invested in the right place for you and the returns that you can achieve. The best thing for you is to get some information and some knowledge so that you can ask the right questions. And that's all I'm here to do today, just to inform you and give you some information. So I've been telling students about this for a long time, and often they come out of my class, their eyes are wide open, they're like, Justin, no one ever told me this. It doesn't get taught at school. It certainly is unlikely to be taught to you by your financial services broker. Because one thing is for sure, financial services broker is trying to get you to invest in their product so that they can make their own revenue and their own profits. So one of the things that I enjoy in standing in a classroom and teaching the subject of finance, where I'm not there to sell a product, I'm there to educate. In that environment, students are able to say, well, hey, I'm willing to listen to someone who's not here to sell me something. So I'm not here to sell you anything today. Here I am telling you and hoping to educate you about the one thing that I learned about that helped me improve my ability to invest for retirement and get ready for the years of my life when I'm not going to be working. So I'm going to take you across to my computer and I'm going to show you a few things. We're going to do a few calculations. So come with me, and I think I am going to reveal a few things to you that might be material in the way you think about yourself and how you invest money. Come on, let's head on over. Right, so here we are. What I've done is I've just typed into Google Regulation 28 of the Pension Fund Act, and I am going to go with this little box that came up first here. Let's go and see what Regulation 28 is all about. And this is some information that's provided by Sanlam. Thanks, Sanlam. My intention is not to give them a whole bunch of free advertising. It's just convenient. All right, so let's have a look here. Regulation 28 is issued under the Pension Fund Act. It limits the extent to which retirement funds may invest in particular assets or particular asset classes. The main purpose is to protect the members' retirement provision from the effects of poorly diversified investment portfolios. In other words, what they're saying in that statement, it's designed to protect you from the people who are investing your money and might invest it poorly. Oh, wow. Okay. This is done by limiting the maximum exposure to more risky asset classes. All right. So we're going to think about what does more risky mean. Making sure that no unnecessary risks are taken with retirement money. Okay. Well, that's useful. Thank you very much. Let's head on back here. And why don't we go to the government website and go and read a little bit about what they have to say. Yep, that looks like a government document, that's for sure. Government notice to National Treasury. I'm going to scroll down here. I'm not going to read all the bump that's going on here. I'm looking for something that, when I see it, I will know it. Let's go. Okay, so that is all the detail. I wonder if there's a summary underneath this. Here we go. Here we go. That's good enough. Regulation 28 prescribes maxima for various types of investments, blah, blah, blah. The prevailing maxima are broadly as follows. Okay, so here we go. Not more than 75% may be invested in equities. Not more than 25% may be invested in property. Not more than 90% may be invested in a combination of equities and property. No more than 5% to be invested in the sponsoring employer. In other words, if you work for ABSA, you can't have more than 5% of your retirement invested in ABSA. All right, no more than 15% may be invested in listed equity with a defined large market capitalization, and not more than 10% in any other single equity stock. Okay, so they're trying to get you to spread your risk there. Not more than 20% may be invested in any single bank. Not more than 15% may be invested offshore
although increased foreign limits by the South African Reserve Bank are accommodated, blah, 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 not more than 2.5% may be invested in other assets, whatever they are. There are no restrictions on investments into bank-issued money market instruments, in other words, just investing in cash, or in government-issued bonds. In other words, you can lend as much money as you want to the South African government. Okay, so there's the regulation. What I'm going to do next is I'm going to open up a spreadsheet and I'm going to show the impact of this protection, as they call it, protection against poor investment, and show you how this might impact you in your personal investments in your retirement fund. So hold on for my spreadsheet coming up next. All right, so let me share with you a graph that effectively describes the South African market. Okay, so starting at the top, this thing is called the All-Z returns chart. All-Z is the all-share index, and a return is the change in share price from one year to the next. And I'm using data here that goes from 1980 all the way up to pretty much yesterday. Note that this data is in a logarithmic scale, and the benefit of a logarithmic scale is it changes the data from an exponential chart into this more straight line chart. So what do I mean by an exponential chart? Well, if you give me a sec here, I can show you a share price chart. Now, I haven't updated this for a while, but you will see the principle here. This is an exponential chart. This is actual share prices. And what you see is growth on top of growth as share prices over time get bigger and bigger. What the logarithmic chart does, or the log scale, is it takes that line that bends and goes up exponentially, and it effectively shows it as a, I'm going to use the word flat line, but it's not a flat line. It takes the exponential curve out of the line. Notice how there's an obvious trend here as the chart heads up into the top right-hand corner. And along the way, there are periods of good growth and then some retractions in the market. You might call it a market crash or market correction. And there are some significant events here that have taken place in South Africa's history where markets have retracted, contracted, crashed, corrected, whatever terminology you want to use. And kind of most recently major event is the 2008-2009 financial crisis. This is describing the performance of share prices of the top 160 companies on the JSE, approximately 160. So here's this crash where markets fell by 42%, and then there was some growth that came after that. And we've been now for the last 5 years in a recession. So you don't hear people talking about this recession very much because the technical definition of a recession is 2 quarters of negative GDP. However, the markets have gone sideways for 5 years, and that's a very good indicator that there is limited growth and limited investment taking place in South Africa, certainly over the last 5 years. So why is this graph important? Well, if we were to calculate the cumulative average growth rate over the last 40 years, and this is including 2 pieces of important information. Firstly, the share price growth, prices going up, and the dividends that you would receive from those shares, we come to a growth rate of around 18%. So that tells you, if you owned a portfolio of shares in the South African market over the last 40 years, you could have got a return of approximately 18% per annum. So we're going to use that information because that's important. We're going to go and see if we invest in a pension fund, what return do they get, or retirement annuity, pension fund retirement annuity, we'll use that word interchangeably, or what would you get if you invested yourself? Okay, now you might say, well, investing myself is complicated and I don't understand all this stuff. And I'm going to suggest to you that the financial services sector is very happy that you think this is complicated and that you can't do it yourself and that you should outsource your investments to someone else. That is very suitable because it means it's an opportunity for this sector to make some good money off of you. And I'm going to show you how they're doing that in a moment. So there's the performance of South Africa. I do want to just show you that after there's been a major crash in the market, this is a decline of 43% in 44% in October 1987. Look how quickly the market recovers on the other side. And it's almost as if this yellow line is like, it's almost like an average. It is the average growth rate through this data set. When the line gets stretched too high, like an elastic band, it wants to revert back to its natural position. All right, and statistically we call this mean reversion. Markets want to revert back to the mean. All right, and on several occasions you can see when the market is stretched to the upside, it reverts back to the mean and often overreacts. And that's one of the things that markets do, is they often overreact to information or to the current events that are going on. All right, so you can see how we had this tremendous growth curve through the early 2000s. It got well stretched and there was a correction, and then the growth came back. And now we've been going sideways for 5 years or so. Here is the effect of COVID-19, the kind of panic around shutting the market down, lockdown, etc. And the market is nearly fully recovered back to this previous level. So one question we need to think about here, and this is a highly controversial point of discussion, is that if the last 40 years has generated these returns, what assumptions can we make about the next 40 years? Now, you must remember that back here in the 1980s, we were talking about the dark days of apartheid. And you can see how these graphs just grew straight through those times, and even the transition into the new South Africa that happened in the early 1990s. And I would suggest there was a lot of hope and optimism that drove this. And then there was a lot of new money that was invested in South Africa as we made this transition, and we were able to come through successfully. The challenge we're facing at the moment in these last 5 years is there's a lot of capital leaving the country, going to invest in other areas or other countries where those countries make investment easier, less regulation, easier to access the market. So we need to ask ourselves, is it realistic to assume that we can continue to get 18% into the future? I'm a little skeptical, but you know what? I like to think that as South Africans, we are resilient and we'll find a way forward in order to get our economy back on the right track and assume some sort of growth curve into the future. Let's hope for the best. So I'm going to transition away from my chart here, and I'm going to go back to a spreadsheet, and we're going to use some of these numbers in order to learn a little bit about your investment in your pension fund. And I'm going to tell you about that one thing that I learned that really changed my ability to see how my money is invested and to get more out of what I invest. I have created a blank spreadsheet. I've given it a name at the top here, and I've called it Travel in My Time Machine. And the reason why I've called it that is because we are going to travel back to the year of 1980. And assuming we are in 2020 at the moment, that is going to be effectively 40 years. Not 40%, 40 years. There we go. 40 years in time. And what we're going to do is we are going to take with us back to 1980 some money. We're going to take with us 100,000 Rand so that we can invest it in the market back in 1980. So we're going to invest 100,000 Rand in the market for 40 years, and hopefully we're going to get a return. Well, we know if we go back in time, we would have got a return of 18%. So let's put these together with some headings. We're going to make an investment. What's this investment going to be? It's going to be 100,000 Rand. How long is it going to be invested in the market for? This is going to be 40 years. And what return can we expect over this time? We've learned that this can be around about 18% is quite a reasonable expectation. Okay, so we've gone back in time. We're going to invest this money in the market, this 100,000 Rand, and we're going to find out, once we've got back in our time machine and traveled back to the future. Yeah, I did say that. Back to the Future. Sounds like a good name for a movie. We are then going to go and see what has happened to our investment over this time period. So effectively what we are looking to calculate here is something called the future value. And the formula that we're going to use to calculate this is we are going to take the investment, the original 100,000. We're going to multiply it by 1 plus the return, and we're going to do this to the power of time. All right, so there's the formula, and I'm going to show you how this formula works. It's quite simple, really. Let's go ahead. There's my investment. I'm going to multiply this, open brackets, by 1 plus 18%. All right, let's pause there for a moment. I'm not going to do to the power of time. I'm just going to do that calculation and see what happens. There we go. 18% of 100,000 is 18,000 Rand, and it's added it to the 100,000 to get 118,000. So that would be the value of our investment after year one. All right, so let's just be clear on something. I am assuming a smooth return of 18% per annum. That doesn't actually happen. You know that. If I bring this spreadsheet back in here and I show you the chart, 18% is the yellow line that runs through this. Actually what happens is this thing bounces around a little bit. There are years when you're going to get minus 44, and there's going to be years when you're going to get plus 44, depending on what happens. All right, but the average will be 18. So that's what we're using here. All right, so there we did the calculation for just investment, for the period of investing over 1 year. We are now going to the power of 40, and we will find out how much our 100,000 Rand will become after investing it in the market for 40 years. Now what's important here is that the dividends are reinvested. We are earning dividends from these companies that we are invested in, and we're taking those dividends and we are reinvesting them in the market. And what's happening here is our money is compounding by share price growth and owning more units in the investment in order for it to grow over time. And it turns out we will have 75 million and some change over 40 years. All right. So often when folks see that number for the first time, they are like, oh, wow, that's quite a number. Now, here's the part that I think is going to surprise you. What I'm going to do is I'm going to show you the case for if you invested this money in your retirement annuity or pension fund instead of investing it directly in the market yourself. Okay, so there's a few things that we need to adjust here. First of all, if you invest in a retirement annuity or a pension fund, you need to pay some money to what's called a pension fund administrator. Let's just call it pension fund admin. All right, and that fee, I'm just going to use some general numbers here. That is a pension fund. That fee is about 1% per annum. And you would be paying that money to a company like Alexander Forbes, or there are a number of other companies, typically Sanlums or Old Mutuals or these kind of non-bank financial services often administer these pension funds. All right, so we've got to take these fees into account. Now, it turns out that the pension fund administrator is not the company that's actually doing the investing. They hand over your money to let's call them a fund manager. All right, and here is your Alexander Forbes, sorry, not Alexander Forbes, they're a pension fund administrator. Here we're talking about Alan Gray and Prudential and Coronation, and most of the banks have a fund manager or asset manager division. And these are the folks who generally earn the big bucks and 2% is definitely not an unusual fee for these fund managers. So what this means is we need to take this fee into account when we measure the return. So if we recalculate this, I'm just going to take this data. I'm going to use the good old Control-C, Control-V. And what I did here is not very smart, because I need to tell Excel that I must use this data because I had these formulas in here. So let's just correct that. All right. And so here's the formula. Here's the calculation that got us 75%. Now, the problem is we need to take this 18% and we need to subtract from that. We need to subtract from that this 1. And then we need to subtract from that this 2%. All right, let's see what happens if we do that. Oh, wow. So there we go. That's interesting. Instead of generating a return of 75 million, we now have a return of just 26.7 million. And that's because we've had to take into account the fees that these folks earn. What's the difference here? Just out of interest, let's do a little calc here and tell us that we are losing out on 48 million rand of our own potential wealth because we have outsourced this function to the asset managers. When you're having a conversation with the asset managers, these people are going to try and sell you the idea that they generate returns that are higher than 18%. Now you need to ask yourself, do they do that consistently every single year for 40 years? Or do they do it sporadically and occasionally, depending on years in which they get lucky when they beat the market? So I know for certain that there's no one company that beats the market every year over 40 years. So if your pension fund manager or your broker is telling you that they generate returns that are higher than 18% for 40 years, I'm going to look at them a little sideways and think that they're telling some little pork pies there. Here's the thing. Let's tidy this up a little bit. What we have done here is we have just taken into account the fact that there are some fees that get paid to these pension fund managers. But in reality, what we haven't done yet is taken into account this thing called Regulation 28. So Regulation 28 doesn't allow you to take this 100,000 Rand and invest it fully in the market. Remember, it said to us that we can put a maximum of 75%. Let's do this calculation here. We can put a maximum of 75% into equities. All right. And then we can put as much as we want into government bonds. So that's what I'm going to do. I'm just going to make this quite simple for now. I'm going to put government bonds there. And I'm going to say to you that a government bond kind of earns long-term average around about 8% per annum. All right. And government bonds are supposed to be very safe, and it's interest earned, and you get paid twice a year. And the theory is the government can't go bankrupt, so you'll always be able to get your money back. All right, all sorts of red flags are going off for me around governments not going bankrupt, etc. However, let's just go with this for a moment. And let's assume that we have a very simple retirement portfolio where we put the maximum amount into equities. So therefore, if this is the maximum amount, 75%, earning us 18%, and if government bonds earn us 8%, that would mean that we've got 25% of our money invested in the government bond. All right, so we're going to do a little calculation here called a weighted average. And the way I'm going to do that is I'm simply going to say, what is 75% of 18? And what is 25% of 8? Get the proportions. And I'm going to add these two up over here. And what this is going to do for me is it's going to tell me that 15.5% is a return that we are likely to get if we are invested in these two asset classes. So just to confirm how this maths works, if you are 100% invested in equities and had no money in government bonds, well, then you would be fully invested in equity and your average would be 18%. If you invested nothing in equities and 100% in government bonds, well, of course, your average would be 8. And if we went half-half, our average would be 13. Now, we're going to follow the regulation 28, and we are going to do this. Now, I get there are other ways that this can be done. There's cash investments, there's offshore, there's all sorts of other asset classes. But this is like the simple and the maximum exposure, if you want, to local equities. All right, so there's the 15.5% that you would earn. Now what we need to do is we need to bring in our pension fund administrator here and our asset manager, because we're going to pay their fees. So let's take these guys out of here. And where are we? We're now at a return of 12.5%. Okay, so what we should do is we should do another calculation over here where I'm just going to use all this data, and I'm just going to tell Excel to make these equal. And in here where it's 15%, I don't want to use 15, I want to use 12%. All right, now we're going to do this calculation again. Let's copy and paste it here. And let's see what happens. Wow, let's see. If you invested 100,000 Rand over 40 years in a regulation 28 type of investment, and you got a return of 12.5% per annum, which you would have got had you invested in the market, you would have ended up with 11 million Rand in your bank account after getting back from your time machine travel journey. However, had you invested this money yourself in the index, rather than splitting it with government bonds and paying these advisors and admin people, well, then you would have got 75 million. And look at the difference. Look how much you're losing out on because your money is invested in a pension fund and using all these administrators to manage it for you. All right, now let me be careful. Let me be very careful here. I am not trying to say to you that you must phone up your broker, cancel your pension fund and your retirement annuity and go and invest the money directly in the market yourself. That is not the intention here, because I'm not an asset manager or a financial service provider. My intention here is to educate you, just to show you what's going on and to make you think about how could you invest your money in the market in addition to what you might have already done in your retirement annuity or pension fund, so that you can access perhaps some higher returns in the market. How can you go about this? By just taking some small baby steps into the shallows of the water, where you can maybe get better returns so that your future self might thank you for the fact that you have done this. All right, so this is the first step of educating yourself around investing in the markets and the impact of what's happening in your retirement annuity and pension fund. I suspect that if you are employed and the company at which you work, it is part of your employment contract that you have to contribute to their pension fund. And it's important to know that if you're contributing to a pension fund, then there's a certain amount, I think it's 27.5% of your salary, that you can contribute to a pension fund and reduce your taxable income quite substantially. Now remember, when you invest directly in the market, you invest that money with money that's called after tax. In other words, you've paid tax on it. When you invest into your pension fund, you can invest in before tax money. All right, so that's one of the major advantages, is you get this tax discount. Okay. The problem is at the other end, once you retire, there are all sorts of tax implications around how the money is distributed to you. So I'm not going to go into that conversation today. That's for another day. For today, I just want you to recognize the cost. Here it is. The cost of outsourcing your retirement to the professionals and to this Regulation 28 that is there to protect you, supposedly, but is actually acting as a handbrake on your investment. The Regulation 28 has some major benefits to it as you get closer to retirement. In theory, as you get closer, you should be closer to retirement. You should be taking money out of equities and putting it into a safer investment. But if you are just starting your career and you're in your early 20s, I'm going to suggest to you that putting money in government bonds at that early age is not the best thing for your retirement portfolio. At the moment, I'm age 48. I am fully invested in equities in my private portfolio. This equity number for me is 100%. There are no government bonds in my portfolio, and there are none of these fees where I invest. In fact, that's not true. There is a very small fee here. The company that I invest my money with actually charges 0.1% fees, and I have to show that decimal place there to see it, so that hopefully I'm earning 17.9%. Now, unfortunately, over the last 5 years, 18% has not been the case. There's been dividends that have been earned, maybe 3%, 2.5% to 3% per annum, but there's no share price growth in there. So that's majorly concerning. And I'm hoping some things are going to turn around here. And perhaps what needs to happen is we need to think about investing money in offshore markets in order to make up for this. But for now, I'm going to leave it there because my intention was to educate you around where your money is invested and to show you that when I learned about this and the power of compounding and the burden of being invested in retirement annuities and how that impacts on your returns and my returns, I changed how I invested my money. But I chose to get fully educated in this market before I made any changes. So that's my warning to you. Don't go and do anything without ensuring that you know what you're doing and you know what the risks are when you're doing it. However, let me not discourage you from becoming educated around how your money is being invested. I hope this was helpful, and I look forward to sharing more around this subject at a later date. Over and out from Justin.